Hey, I'm here with Brad Lyons today. Brad is our investment manager here at Wiser Wealth Management. And I want to talk briefly, Brad, today about bonds inside portfolios. One of the questions we get in our client review meetings very often is, why do I still have bonds in my portfolios? I thought bonds are supposed to be underperforming for the next decade.
Well, bonds have had a difficult time in this marketplace, but the reasons for holding bonds in a portfolio are as valid today as they were ever before. Bonds provide us with a couple things when we're putting together a portfolio for an individual to achieve a specific objective, such as retirement. Let's call it that. So bonds do a couple things, as I mentioned. Bonds, one, provide us with an ability to mitigate or lower the risk of investing in equities or stocks, okay? Stocks have risk when you invest in them. Stocks have risk that you don't meet your expected return by investing in stocks. Stocks have a variability of return year after year after year, but we know over the long time they averages out to a certain return, which we try and calculate out to the future when building the portfolios. Since there is investment risk in that, bonds provide us with a more stable return and stable principal. Okay, they have an interest rate or a coupon rate, as may be referred to, that provides income to the investor. Now, yes, the income is much lower today than it was years ago. I mean, I remember when bonds were paying 15, 16%, but that was tough times in the U.S. as well, okay? I don't know that we're going to get to that anytime soon, for sure. But we are going to see interest rates begin to rise, and that way bonds in the portfolio will provide that secondary objective of income along with stability of principal. We're in somewhat unprecedented times here, Casey, as you know, and as most of our investors do know, that we are coming out of a very historic low interest rate environment. The Fed has kept the rates down towards 0 to 0.25%, making money very inexpensive for borrowers to buy things, which has caused inflation in our economy as well. Now, inflation is a monetary phenomenon that we've always had and will always have, but right now we're at a 40-year high, so it's kind of at a peak with all this excess liquidity in the marketplace. I think that as the Federal Reserve now begins to taper back the bond purchases that it's been making in order to provide additional liquidity to the system, it begins tapering that, and it'll eventually take that down to 0, which should happen first or second quarter of 2022. And then afterwards, they want to follow up immediately with begin to raise interest rates slightly over the next couple of years. It could be that we get as many as 3 interest rate increases next year, but probably is at least 2. So we may be looking for one in the end of the second quarter, early third quarter, again in the fourth quarter, and then continuing on in 2023. But that's getting out a little far for us to see. So as we're going through these different scenarios that are occurring in the marketplace, as an investment manager, we're following best practices in managing portfolios in different interest rate environments. So we're looking at high quality bonds, high quality investments called investment grade investments, and keeping the duration of the bond or bond portfolio shorter than what would be called the U.S. aggregate bond index. Duration is a measure of volatility in bond prices. So as your duration goes longer, the volatility of that bond portfolio increases relative to every interest rate rise, every 1% interest rate rise in the marketplace. So by keeping it short, the reinvestment and the maturity is shorter, so therefore the reinvestment of that bond can be done at a higher interest rate on a faster basis in your portfolio.
So it sounds like in the short term we should expect probably losses on the bond side of our portfolios, but a bad year in bonds is nothing like a bad year in stocks. It's a smaller percentage, but nevertheless, why do we keep investing in bonds? And I think the answer really comes down to, kind of summarizing everything you've said, is rates are going to be higher. So we want our bonds to mature sooner so we can get to those higher rates.
Correct.
Right? That's so we just kind of wade through this. But what I see is really comes down to more like behavioral investing. It's the black swan event that we don't know about, that there's no headlines about. And it's kind of like what COVID-19 was in 2020. We kind of saw it coming, but we didn't at the same time, right?
Right.
There's all these projections of how bad it was going to be, but no one's ever really experienced that, where bonds held up fairly well at the beginning. In the end, it took some government backing on some bonds to really support those. But bottom line is we saw an increase in the value of bonds rather rapidly inside the portfolio. We were able to sell those for gains, buy stock at a lower price. It gives you that opportunity, especially for more traditional investors that are 60 stock, 40% bonds. So I think what we're saying is don't give up on your bond portfolio.
Right, it's a way,
but be smart about it.
That's right. It's the basic diversification aspect of a portfolio. You want different asset classes that behave differently in the same economic event that's occurring at the one time. So by having that sort of diversification in a portfolio, like you said, you have the opportunity as an investor or asset owner to withdraw money during that period from either type of asset class, the one that's performing best at that point in time.
The only alternative is to hold cash in lieu of bonds. In that scenario, you would have lost 6.8% over the last year with inflation.
With inflation,
right?
That's right. Loss of purchasing power.
Another thing, you could purchase possibly some type of an annuity with that side of the portfolio, but you're locking your money away for 10 to 14 years. And when the market does rebound, you're stuck in a very expensive product. So
that's right.
We typically would never recommend annuity as a solution. There's times you could use CDs, but right now CDs, if your bank's offering you 5%, I'd say that banks on the way out of business. There's no reason for them. There's no incentive for them to be doing that.
Again, that's the classic. If it sounds too good to be true,
yes,
it probably is.
So really, we look at the bonds as not so much even for income anymore. It's really there for portfolio stability,
yes,
and help you sleep at night.
Right.
Otherwise, you just be 100% stock. But if there's a 30-40% sell off, you're probably still not going to be in stock. That's just human nature. And so the bonds allow you to kind of hedge that a little bit, the volatility.
Right. So we're keeping diversified portfolios. We're keeping our bond portfolio investment grade. We're keeping the duration short. And we're going to weather through this.
Thanks, Brad.
Thank you.